Hello, everybody. Welcome. This is managerial relevant costs for making decisions. We're going to look at today accepting additional business. So my disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Presentations from time to time will use information from third parties. The third party information is the property of those respective copyright holders, and the author does not make any claim to the third party information. Okay, with that all being said, let's go ahead and take a look at our question that we're going to be looking at today. So we have Zizix Inc. produces high. By the way, I actually knew on one of my son's baseball team, there was a kid named Zizix, which is an awesome name because it's a road off of when you're driving up to Vegas. Fun stuff. So Zizix Inc. produces highway road signs for various state entities. In creating 5,000 road signs during the 2026 year, ZI had the following costs and expenses. So we have revenues, less our expenses, which are direct materials, direct labor, factory overhead. We get to our total cost of goods sold, and then that's going to give us our gross profit, less our SG&A. And then we come over here to our net income. Of the 1 million of factory overhead, 600,000 is fixed at any production level, from 4,000 to 7,000 road signs, while the rest is variable. Now, what I can do, and this might be not a bad thing for me to do right now, is to take the factory overhead and break this up as variable, and then my factory overhead, and show this as fixed. So of the $1 million of factory overhead, 600,000 is fixed at any production level. That must mean that the other amount was 400,000. So again, this initially was $1 million. And what I'm doing here is I'm just basically breaking this up. And again, my total cost of goods sold is not changing. What I'm doing here is I'm taking this factory overhead and breaking this up, and we'll see why this is going to be important for us later. So here's the thing with accepting additional business, and this is what I want you to be thinking about. Presently, how much money am I making on my existing business? Well, what am I making? Let's take a look at this. How to determine net margin. So you're taking your net income and dividing it by your sales. It's not gross margin. This is net margin. So our net margin on our existing business is going to be $1,430,000, or the net income divided by the revenue of 6.5 million. And so my net margin is going to be 22%. So this is a very important number for us, and we'll talk about this a little bit later. But if I'm accepting additional business, I want to go through and keep this in mind as whether or not we should decide to go forward. Okay. Let's keep this down over here. Okay. So we're approached by a customer offering to purchase 500 road signs for $800 each. We're going to call this the new order. So the first problem with this, and I would pose this to you, if you're selling something for 1,300 and someone's offering to buy it from you for 800, right? This is roughly a 38% discount off of, right, the current price, the proposed price, and this is giving me the discount, right? So they want a 38% discount on the deal, right? So someone's approaching me and offering me 500 road signs for 800 each. The first thing I will tell you is we have to be extremely price sensitive. If I tell a customer that they can buy it for 800 bucks without, doing some other things first, I may get in big trouble, because once I tell the customer that they can have the better price, word is going to get out. Before you give a price to anyone, you have to make sure you know what your costs are, your market, your margins, all those things. It's incredibly important that you go through and do that. So what I would tell you is that, this problem, we're going to go through and basically go through this and figure it out. But if we're going to give this amount of a discount, what we would want to say is like, hey, if you buy 1,000 signs, here's your price. If you buy 1,500, you'll get a volume discount. So we're going to assume for this, for the moment, that they're getting some sort of a volume discount, right? So the production manager shares with you that as a result of the new order, direct materials costs will increase on a per unit basis by 40%. Direct labor costs will increase by 50% on an hourly basis. The variable factory overhead rate will remain unchanged. No sales commissions will have to be paid. Total selling expenses will increase by 15% as a result of the new order, and total G&A expenses will increase by 5% as a result of the new order. We're being asked to prepare an income statement similar to the existing business for the new order only. So let's go through and work this out. So I need to basically come over here and say, okay, my revenues for the new order. Okay, so basically over here, basically the units are at 500. I'm being offered to buy these. My per unit is at 800. So the total revenues as a result of getting this new business is going to be 400,000. So that's my revenues less my expenses. I'm still going to have Demon Master or direct materials. I'm still going to have direct labor. So let's go through and look at those first. So what does it tell me about my direct materials costs? It says it's going to increase on a per unit basis by 40%. So to make 5,000 road signs, it's going to cost me, it cost me 200,000. So the per unit for the direct materials is going to be 200,000 divided by 5,000 units. This is my per unit direct materials. Okay. Very, very important that we see this. How did I get that 40 bucks? Well, the 40 is going to be 200,000 divided by the 5,000 units produced, or 40 per unit. So that's what we're going through and looking at right over here. So it tells us, though, that the cost of the direct materials is going to increase on a per unit basis by 40%. So the new rate, or the new per unit, it's increasing by 40%. So if I multiply this by 1.4, I get 56. Another way I could do it, as I say over here, I've got 40 bucks, right? If I do a 40% increase, or $16 per unit, my new cost is 56. So over here, we can just say that the new rate over here is 56, or multiply it by 1.4. You're going to get the same answer. So over here, for my direct materials, if I sold 500 units, I'm going to need direct materials for 500 units. This is going to be at a rate of $56 per unit, or a total of 28,000. Let's go ahead and take a look at the next one. Over here, direct labor costs will increase by 50%. And we should just really say on a per unit basis. And just give me one moment. I want to change this around on some of the other parts. Okay. So the direct labor costs will increase by 50% on a per unit basis. So the cost of my direct labor per unit is going to be 70. How did I get 70? I'm going to take 350,000, divide it by 5,000, and this is going to give me 70 per unit. So this is my existing rate. It tells me that it's going to go up by 50%. So I can say, well, 70, which is my current rate, at 50% increase, my new rate's 105. Or I can take 70 times 1.5 and I'm going to get the same answer. So for my direct labor, if I sold 500 units, I need to take 500 units to my cost of goods sold. So this is going to be at 105. So this over here is going to be 52,500. Now, the next one over here, remember, I broke this up between variable and fixed. The fixed factory overhead over here, or the fixed overhead was $1 million. But the question told me of the $1 million of factory overhead, 600,000 is fixed at production levels from 4,000 to 7,000 road signs, while the rest is variable. So what I did is I said over here, my fixed overhead, factory overhead variable is going to be 400,000. My fixed overhead is 600,000. These two add up to $1 million. Now, why did I do it this way? It's because I'm right now producing 5,000 signs. If I produce another 500, I'm going to be at 5,500 road signs. Therefore, my fixed overhead will not change. So don't worry about the fixed overhead. So the factory overhead fixed for this particular question is going to be not applicable because we are within the production range. When I write out things like this, if you're a student in one of my classes, I write this out so you know that I'm not including the number. You don't have to do that on the test. So the variable factory overhead will remain unchanged. What is my variable factory overhead rate? Well, if I take 400,000, which is my variable factory overhead costs at 5,000 units, right? This is going to remain unchanged. So coming over here, my variable factory overhead, I've got 500 units at 80 per unit for a total over here of $40,000. So my total cost of goods sold for the new business is going to be a total of 120,500. So my gross profit on the new business is going to be 400,000 minus the 120,500. So this is for the new order. Now let's take a look at the other expenses. So no sales commissions will have to be paid. So as I come over here, less selling, general, administrative, the sales commissions, this is going to be not applicable. It doesn't have to be paid. Now, when I look over here, and I have to be really careful when I'm looking at these numbers. If I take the new business, my total selling expenses will increase by 15% as a result of the new order. So if I take this additional business, my selling expenses are going to increase by 15%, right? So I can come over here and say $1 million times 15%, that's 150,000. So my total selling expenses are going to go from $1 million to $1,150,000, or a difference of 150,000. So it's increasing by 15%. So if I am choosing to accept this additional business, my selling expenses will go up by 15%, or 150,000. You have to make sure that you're reading this part correctly. So again, over here, it's not going up by 150%. It will total selling expenses will increase by 15. So if I take the new business on, it's going to jump up to 1,150,000. Therefore, that incremental or that additional cost is going to be 150,000. Let's go to the next one. Over here, my general and administrative expenses. This over here will increase by 5% as a result of the new order. So for this part over here, this is basically, we'll call this selling. For the G&A, this is right now at 2 million. This is going up by 5%, or $100,000. Therefore, if I accept the additional business, it's going to go from 2 million to 2.1 million, or an additional cost of $100,000. So if I take on the new business, I'm going to have an additional cost here of $100,000. So my total SG&A is going to be 250,000. So my net income for the new order is going to be 29,500. Now, in a lot of accounting textbooks, they're going to tell you, well, as long as that number is positive, go through and do it. But I'm not an accounting textbook. What I will tell you is this: if you get approached by a salesperson, what do salespeople care about? They do not care about the company. They care about themselves, and they care about making money. And that's what salespeople do. That's fine. However, when we're looking at this over here, let's just take a look at something really quickly. The net margin, and I want to go back to what we were first going through and looking at. The net margin for our existing business was over here. Was 22%. Okay. So this was the net margin of our existing business. The net margin of the new order, right? By the way, very good 80s band, grown to appreciate them as I've gotten older. So Jimmy, that one was for you and for Chris. So coming over here, my net income for the new order was, I'm in shell shock, and it's a Blue Monday. So over here, 400,000, right? That's going to be the revenue for the new order, right? So coming over here, the net margin for the new order is roughly 7%. What I have to be very careful about is when I'm dealing with salespeople who are maybe bringing this in, the salesperson maybe just cares about a commission. They're not getting paid anything here in this case, but my selling expenses are going up. So what I have to be careful about is that this new order has a lower net margin than my existing business. Do I want to take on the risk? Is it worth the risk to go through and to do this additional business? I don't know. Is it a good idea? I don't know. If we compare the net margin of the existing, we may decide not to do it. And again, it's going to depend upon the confidence we have in the numbers that are being produced. Now, If the net margin, right, by the way, we have to make sure that these direct labor costs are good, direct materials, variable overhead, that these are real numbers. So when you think about it, if you're ever accepting additional business, you really want to make sure that the numbers are going to be good. And that's all we can really do. So in this case over here, I could argue either way, but I would probably say because the net margin is lower, I would probably choose not to take the additional business. Again, and you'll hear different things from different people. But again, is it how experienced are they at taking additional business? Can I get this price over here? Is there a way I can basically give this to the customer where the customer is not going to expect that they're going to be getting, more or less money, or they're paying so little for this? So again, those are different considerations we have to have as we're going through and doing these different types of questions. So I want to thank you for being here with me today. Thank you for watching. If you have any comments, please feel free to send them to me at 1812cpa@gmail.com or leave a comment below. Thank you for liking and subscribing, and I look forward to seeing you on future accounting videos. Always fun.